Hi guys, welcome to this Money Control live stream. It's a Monday morning, it's a brand new week and lots of cues to watch out for this week. It'll be an earnings heavy week. You have India's largest IPO that will be opening up for subscription tomorrow, the Hyundai Motor India IPO. So yes, lots of cues to watch out for. Of course, if you talk about global cues, we had Wall Street hitting fresh highs on Friday. Asian markets are largely mixed, but looking at the pre-open and looking at the GIFT Nifty cues, looks like we are poised for a positive start, although we didn't really hold on to that 25,000 mark last week. This week, of course, that crucial level will be put to test. Lots to watch out for. You had big boy Reliance Industries reporting numbers today. HCL Tech from the IT pack will be reporting numbers. We will be digesting numbers from DMart as well that came out over the weekend. And of course, lots of other stocks will also be in focus and we'll be touching upon them as well. Your stock related queries will also be in focus. If you have any queries, of course, keep them coming in on our live feed on YouTube. We'll try and get them addressed as well. But of course, before we move any further, let's take a look at the top headlines at this hour. Wall Street closed at record highs on Friday amid a sharp rally in financial stocks. Meanwhile, Asian markets are mixed on lack of clarity over the stimulus in China. The GIFT Nifty suggests a flat start, but it is splitting below the between the positive and negative territory. Crude prices correct, with Brent slipping over 1.5% to below $78 a barrel mark on worries over disappointing inflation data and a lack of clarity over stimulus measures from China. Index heavyweight Reliance Industries is set to announce its second quarter earnings today. Overall performance is expected to improve sequentially. O2C and retail business to report some weakness, but Jio is likely to benefit from tariff hikes. Also watch out for numbers from HCL Tech. And IIP for August contracts for the first time in nearly 2 years. Meanwhile, CPI for September is due later today and is expected to come in above 5% amid a reversal in the base effect. Well, on that note, let's take a look at the cues for trade then. Sensex and Nifty, of course, fell for a second straight week last week. In fact, the Nifty failed to hold on to that crucial 25,000 mark on the upside. Both the indices were down 0.3% for the week, but mid-caps managed to outperform larger peers. Pharma and auto, these were the two sectors that gained the most last week. FMCG and auto stocks were under pressure on the other hand. Particularly looking at Friday's session, markets were range bound for a second straight session. In fact, we've seen the markets, opening up on a positive note, all this while last 3-4 sessions. But, it really failed to hold on to gains and ended manages to end the day on a very flattish note and, giving up all the intraday gains. So that has been the kind of trend that has emerged last week. But financials, of course, were a big drag on Friday, with ICICI Bank and Axis Bank emerging as the top laggards. TCS, mind you, handed in an earnings miss, margins miss estimates. And because of that, the stock was under pressure, although other IT stocks were doing well. So TCS in particular hit a 3-month low as earnings missed expectations. In terms of FNOQs, put call ratio fell to 0.84 vis-a-vis 0.93 in the previous session. No new additions in the FNO ban list for today, but quite a few stocks remain in the FNO ban. Quickly taking you through all of them: Chambal Fertilizer, GNFC, Granules India, Hindustan Copper, IDFC First Bank, Manappuram Finance, PNB, RBL Bank, as well as Steel Authority of India. A couple of counters, have exited the FNO ban list as well. Bandhan Bank, of course, that stock was, among the gainers on Friday on the back of positive news flow. Birlasoft, Tata Chemicals, these are some of the other counters that have exited the FNO ban list. But of course, FIIs continue to remain net sellers in the Indian market, whereas DIIs or domestic investors continue to pump in money in the cash markets in Indian equities. But let me quickly bring on board then our technical expert for today. Joining me is Ruchit Jain of 5paisa.com. Ruchit, great to have you on the show. 25,000, that level, we failed to really hold on to it, although we have crossed that level quite a few times last week. This week, do you think that will be a crucial level that will be put to test, given the fact that we have quite a few earnings to digest? And speaking about the Nifty Bank Index, it did see bouts of buying last week, but Friday particularly was a down day.
Yeah, hi, very good morning. Well, if you look at the recent sell-off in the month of October, it has mainly been led by FI selling. Right now, FI started this October series with a long-short ratio in index futures of about 81%. And historically, we have seen that whenever they have this 80-85% kind of range coming in, markets make a short-term top and we enter a corrective phase because of the profit booking or long unwinding by them. Now, in this first half of October so far, they have not only unwound the long positions but have also formed fresh short positions, and hence their long short ratio is now around 35%. This means that about 65% of the positions are now on the short side, vis-a-vis where 81% of the positions were on the long side at the start of the series. So I think no, this is one factor which would restrict the move in the markets, at least in the near term. Now markets have retraced 61.8% of the previous up move. So no, I think last 3-4 trading sessions we have seen some consolidation within this range of 24,700 on the lower side, which should act as a support, and 25,230 250 is the resistance zones. So we do not expect any significant directional move until either of these levels are taken out. So it would be maybe no, we would continue to see some consolidation phase, but 24,700, that would be the crucial support level to watch out for. Till that is intact, no, I think biasness remains a bit positive for stock specific momentum. But 24,700, 25,235, or 25,250, this is the real. These are the levels that we are watching out for. And in case if we get a breakout on the either side, then some directional move would come in.
All right, that's about the Nifty then. But let's talk about the metal pack as well. China, of course, has pledged to significantly increase debt to revive its sputtering economy, but it has left investors guessing on the overall size of the stimulus package. Now, Beijing will help local governments tackle their debt problems, offer subsidies to people with low incomes, support the property market, and replenish state banks' capital, among other measures. Now, these are all steps investors have been urging China to take as the world's second largest economy loses momentum and struggles to overcome deflationary pressures and lift consumer confidence amid a sharp property market downturn. But omission of a dollar figure for the package is likely to prolong investors' nervous wait for a clearer policy roadmap. Ruchit, we saw some action in the metal pack, in anticipation of a fiscal stimulus. Although, they have said that, stimulus measures will be taken, but there is no figure, or the size of the package is largely unknown. Do you expect the metal stocks to see some bit of a selling pressure in today's session, given the fact that we saw a run up in anticipation of this news?
I think metals have already gone through a corrective phase. If you see since the month of May, no, since then the index has corrected, and recently we have seen some positive traction. So I think no, there are no signs of any significant down move now coming in again in the metal stocks in the near term, and these are cyclical names. And once their trend sets up, I think in the short to medium term, that can continue with good gains. So I think here downside seems to be limited. We don't expect any big downside coming in certain stocks, but yes, one need to be very stock specific. We may not see a trended move in all the stocks within the metal stocks, but some of the names such as JSW Steel is there, Hindalco is there, National Aluminum is there. They are indicating some signs of outperformance. You can see in the recent corrective phase also, JSW Steel was one stock which was continuously making new highs in spite of other stocks within the sector correcting. So I think some relative outperformance is indicating that there may be some stock specific momentum, and stocks that are outperforming, names which I took, JSW Steel, National Aluminum, Hindalco, I think these are good stocks for short term trading.
Okay, keep all those names that Ruchit mentioned from the metals pack on your radar, in the likes of Nalco, JSW Steel, etc. But the big one today, Reliance Industries, numbers will be coming out post markets. A sequential improvement is expected. Operating margin is seen at 17.5% vis-a-vis 16.7% on a quarter-on-quarter basis. Of course, this is according to the CNBC TV18 poll. Profit is also expected to come in higher at 15,738 crore rupees vis-a-vis 15,138 crore rupees on a quarter-on-quarter basis. Revenues are seen slightly lower on a sequential basis, but EBITDA is also seen up by 2% or thereabouts. There could be some weakness in retail and O2C, but Geo is expected to benefit from the tariff hikes, and Singapore GRM in particular for Reliance will come in, or is seen at 3.6% in the second quarter. Now, Jefferies is also expecting Geo's EBITDA to rise 9% on a quarter-on-quarter basis. ARPUs, or average revenue per user, is expected to rise 7% according to Jefferies, and retail EBITDA should also rise by 5% on a quarter-on-quarter basis. That's also according to Jefferies. But looking at Reliance Industries, the stock is at somewhere around 2758 or thereabouts. What is the next crucial level to watch out for on this index heavyweight now, Ruchit?
So I think today's reaction post the numbers will be very important for the stock, because before the numbers the stock has already seen a correction where the stock made a high of around 3200 in the month of July, and the stock is now trading around 2730, 2750 kind of range. So here 2700, 2750 is a very crucial support for the stock. Even the weekly moving average 89 EMA, if we see, that is coming around 2680 only. So price wise, I think downside seems to be very limited from here on, and since the stock has corrected already before the numbers, in case if we see some positive reaction in the numbers, then I think there is a good scope of some pullback move towards 2850 to 2900.
Okay, that's the view on Reliance Industries. Just about 10 seconds to go for the markets to open, and looks like we are poised for a positive start, because in the pre-open at least we are above that 25,000 mark on the Nifty. The mid-cap index, which outperformed by the way last week, is expected to extend its outperformance this morning as well. And the Nifty Bank Index, likely to open. In fact, the markets have opened. The first ticks are coming in. 25,023 or 25,040 actually on your screens at the current juncture. A good 80-point bump up on the Nifty, and Sensex as well, up by somewhere around 300 points or thereabouts. The Nifty Bank Index is also up 0.3%, 51,300 is where it's at, and the mid cap index moving in tandem with benchmarks today. So no outperformance there, but extending its gains. Let's take a look at some of the other sectors. As to which are the sectors that are doing well and which are the ones that aren't really doing well this morning. Most of the sectors are trading in the green, barring the pharma pack, which is trading with slightly in the negative zone. But what's taking the lead is the metal pack, almost higher by about 1%, the Nifty Metal Index. Of course, we know that China has announced a slew of measures, but it hasn't really put a figure to the stimulus package, which of course, will come out eventually. So some bit of optimism coming in there, and which is what is being reflected in the metal pack. Banks, of course, as I mentioned, is doing well, 0.3% uptick there. IT index, that index is up 0.6%. Remember, TCS numbers were weakish, which is why TCS was down on Friday, but the other IT names were doing well. So the likes of Infosys, Wipro, HCL Tech, all of them were gaining on Friday, and even today HCL Tech will be in focus given the fact that the numbers will come out today post market hours. PSU Bank Index up 0.4%. You have Realty Pack also higher by about 0.4%, but the India VIX Index has risen today. It has cooled off significantly last week, but 2.5% uptick on the India VIX Index as well. Quickly going through individual movers then, let's take a look at what's doing well. Wipro, top Nifty gainer. The company is expected to mull a bonus issue on the 17th of October. I think this bodes well for the stock price, up 3%. JSW Steel, another stock that's doing well. L&T, there's been an initiation, a brokerage initiation on the stock, and the stock is clearly reacting to that, 1.5% up. Tata Steel, BPCL, these are some of the other movers. On the flip side, you had M&M. Axis Bank continues to trade in the red. ONGC, Bharti Airtel and Ultratech Cement, Bajaj Finance, these are some of the other laggards. But looking at the open, Ruchit, any stock recommendations for viewers?
So I think if we look at the opening, then IT and metals, these are two sectors where sectoral momentum seems positive. Within the metal space, we already spoke about 2-3 names within which National Aluminium looks positive. So one can look for buying opportunities over there with stop loss value 220 for potential targets around 247 to 48 in the near term. And within the IT names, I think Infosys would be very important going ahead, because in this entire time-wise correction of last 1 month, the stock has not breached its 40 days exponential moving average support. So if the sector has to resume its uptrend, then I think the leadership should come from Infosys. And till this recent low of 1870 is intact, I think one can look for buying opportunities in Infosys as well, with stop below 1870 for potential targets around 2070.
All right, those are some of the recommendations coming in. Nalco from Metals Pack and Infosys from IT Pack. But one stock that is reacting to its numbers, Avenue Supermarts, that stock is down over 9.5% as we speak. Of course, profits have disappointed. Expectations were that profits would grow in excess of 10%. In fact, 14% was the kind of expectations we were working with, but net profit has grown just about 6%. Revenues are up 14%. EBITDA margin has come in at 7.6% vis-a-vis 8% on a YY basis. In fact, JP Morgan has downgraded the stock to neutral, and target price has been cut to 4,700 from 5,400 rupees per share. It has pointed out that the extent of moderation in the same store sales growth has surprised them, and the lower same store sales growth and revenue forecast, they have lowered these forecasts by 4 to 6% over FY25 to FY26. CLSA on the other hand has an outperform call. Target price is at 5,360. Of course, it has noted that sales and profit are both below expectations, and gross margins are also 30 basis points below estimate, and they have cut their FY25 to FY27 estimate by 13 to 15% to reflect slower sales and higher overhead costs. But they pointed out that the pivot to private labels will place it well to meet future competition. Looking at DMart, 4,200, and over the last 1 month with today's fall, it has shaved off almost 20%. Although on a YTD basis, it is still trading with some meager gains of 4% or thereabouts. But would you be bearish on this stock now, DMart, or would you say that this fall is actually coming in as a good opportunity to buy for the long term?
I think I'll wait for some more time because support base is around 3,900. So I think because of the results impact, we can clearly see a disappointment is there. We have seen a gap down opening today. So in the short term, I think there could be some more unwinding of positions which can drag the stock towards 3,900 mark. Around 3,900, if we see some stability coming in, then one can look for look to review there for bottom fishing. But at current, after today's opening, I would certainly wait for some more time.
Okay, wait for some more time before buying into DMart or taking a call on DMart. But the other stock, that's in focus is Concor. It reported its second quarter update. The total throughput was up almost 6% on a YY basis. Domestic throughput was up 14% on a YY basis. Volume growth has come in much below its guidance. Even the EXIM volume growth for second quarter has come in much below guidance, 3.7% for the second quarter, and for the first half at 3.5% vis-a-vis FY25 guidance of 15%. And both Q2 and first half domestic business volume growth have come in at 14% each vis-a-vis FY25 guidance of 25%. So yes, clearly missed the guidance that the company had given earlier. 1.5% or 2% lower at the current juncture, and in the last 1 month as well, it has shaved off somewhere around 8% or thereabouts. All of these stocks from the sector have taken a breather. Within the pack, how is Concor stacking up now? Do you think the signals on the charts are largely sell signals?
Yes, as of now, there's a low top, low bottom structure which is going on since last couple of months in the stock. And we have seen that the recent pullback move also, the stock did not cross its hurdle of 910 to 920. So unless we see any breakout above that 910, 920, I think the near-term trend would remain on the negative side.
Okay, that's the view on a Concor. But then let's, talk about some of the queries that are trickling in this morning then. HCL Tech, of course, this stock will be in focus. Numbers are coming out today. We have Ayush Khanna wanting to know about, what one should do with this stock. From a short-term perspective, of course, you pointed out that Infosys will be crucial to watch out for. And that's one of your top picks from the IT pack. But how is HCL Tech stacked up? And if somebody has some bit of holding here, should they switch, or should they wait for a particular level, any kind of stop loss before getting out?
So for now, one can continue to hold existing long positions. In fact, last 1 month, there is a good relative outperformance within the large cap IT names from HCL Tech too, where the other stocks have seen some time-wise correction or some price-wise dip. HCL Tech is still trading around its swing highs. So here, I think in case if some positivity comes in results, then the stock has potential to rally towards 1980 kind of range as per the retracements of previous correction. And immediate support is around 1740. So one can keep stop loss below 1740 and continue to ride this trend and can expect a gradual up move towards 1980.
Okay, that's the view. But since we are talking about IT, there is a query coming in on Emphasis as well. From Satya CK, wants to know whether it can be added at the current price for the next 1 to 2 years. The outlook on mid-cap IT seems to be brighter, when I spoke to a few analysts, compared to large-cap IT. What are your own thoughts? And would you say that Emphasis is a good buying candidate? Because last 6 months, we have seen a good 20% kind of an uptick on the stock.
One can look for gradual buying over here. Overall, we have seen a good trended up move in Emphasis too, but within the mid-cap IT names, we would be very selective over here. If you look at in terms of relative outperformance, then Coforge definitely stands out where the price-wise the strength is much higher than some of the other mid-cap IT names. So Coforge is one stock which, if you're looking from 1 to 2 year perspective, then you can take some exposure over there. Even Emphasis, if you want, you can add some over here, but keep some room that in case if we get tipped towards 2600, 2650 kind of range, then you can average out more over there. So overall, does not look much negative, but I won't recommend buying full at current levels. Some partial buying can be done at current levels with some room to average at lower levels.
Okay, that's the view on Emphasis. I hope that answers your query. The next one's coming in on ITC. This one's coming in from Sandeep Ravindran. He wants to know if it's a good time to enter ITC. The stock has, cooled off, right, from 52-week highs. It has seen some bit of consolidation in the last 1 month as well. It has lost somewhere around 4%. Last 5 sessions, it has been under pressure. What are the structure, or what is the structure looking like on the charts now? Should one wait before getting in?
So although the longer term trend looks positive, but I think the stock has entered some short term corrective phase. So this could last for some more time. And major supports on the weekly chart, which is coming around 465 kind of level. So maybe a dip towards 465 can be seen in the near term. So one can wait for fresh entry around 465. One can review if around that support, if the stock manages to show some signs of resumption of the uptrend, then that would be good range to do some bottom fishing.
And what about an HUL? We also have a query on HUL from Ravi Shankar. He wants to know your thoughts. How is this stock stacking up? Because HUL has been pretty sideways if you see the last 1 month chart.
So when one can consider this dip as a buying opportunity, but only for long term. In the short term, I think many of these FMCG names which had already seen a good run up, they have shown some signs of correction, but does not seem to be a downtrend. So it's a correction within an uptrend where the volumes are not that high when the stock is correcting. So I think such dips usually gives a good opportunity for long-term investors. In the near term, we do not expect any significant momentum, but yes, if one is looking from at least 9 to 12 months perspective, then one can look for buying HUL over here.
Okay, that's the view then. Just one query on Bajaj Finance from Vipul Gulhane wants to know your thoughts. Now, this stock has been stuck in a downtrend. All the monthly charts and even 6-month charts, showing very meager, gains coming in. Stock has, been in this 7,000 or 7,200 range. Any level to watch out for on the downside as a stop loss?
It's a broad consolidation phase which we have seen in the stock. If I look at the monthly charts also, then last all-time high in the stock, I believe, was in October 2021, around 8,050. After that, if you look at last couple of years, our markets have done quite well, but still this stock has not given significant returns. Bajaj Finserv was in a similar consolidation where the breakout has been seen in last 1 month. But Bajaj Finance is yet to give that breakout. So whenever we see a breakout above that 7,800, 8,000 resistance, then we expect a good trended phase in the stock. So you can take some limited exposure over here, since I think the corrective phase is most likely would be over going ahead. But keep some room that whenever you get a breakout above that resistance, then you should expect some trended phase going ahead. So in terms of stop loss for existing long positions, on the weekly charts, the stock has strong support around 6,900 to 7,000 range. So one can keep a stop below 6,900 on the existing long positions.
Okay, that's the view on a Bajaj Finance. I hope that answers your query. Let's take up the next query on Lemon Tree. This one's coming in from Pon Rajesh. He holds 1,000 shares at the rate of 125 rupees a piece. The stock is trading at 126 or thereabouts, barely making any profits here. But the stock has been correcting for a while now. Is it time to check out, or would you say, average out and wait it out? What would the idea or thought be here?
I would advise to wait for some further pullback moves, maybe towards 135, and then take a review over there. So I won't advise averaging over here, but the stock has managed to form a good support around 112, 112 to 115 range twice since the month of August. So the swing high breakout will be above 135, 136. So depending upon the price volume action around 135, you can take a decision whether to exit there or not. But not recommended to average, but just you can just hold for your existing positions for some more pullback move.
Okay, that's the view. Hope that answers your query. But the next one is coming in on an Idea Forge from Jiffin. Now, this stock has also not seen any fireworks. Just looking at the 1 month chart, even on a 6 month basis, it has barely given any returns. 680 is where it's at, just coming off its 52-week lows. Would you or are you spotting any kind of trend reversal here anytime soon, or do you think the structure is looking bearish at the current juncture?
So no signs of breakout as of now. There's limited historical data since it's not much time the stock has listed, but whatever historical data is there, we are yet to see any kind of high top, high bottom structure or good price volume action happening in the stock. 620 is a good support for the stock, but the recent data indicates a resistance around 750 as well. So you may see some consolidation or the sideways movement getting continued, but as of now, there are no signs of any positive trended move coming in the short term.
Okay, no signs of any kind of up move at the current juncture. Quickly moving on to the next query then, Raja Pasala wants to know your thoughts on a Motherson's, Samvardhana Motherson, wants to know if he should enter at the current levels or wait for some correction. And he wants to know the short term target. The stock has been in an uptrend, right? Last 5 sessions seen very good traction. So to enter at these levels at 52, almost close to 52-week highs, would you, advise against it and wait for dips, or would you say that there is a lot more upside from here and look at getting in now?
See, at least the downside seems to be very limited from here on. The stock made an high of around 210 in the month of July. Then it went through a corrective phase where it corrected from 210 to 170. Then consolidated for a while. So this clearly indicates that time-wise as well as price-wise correction is done in the stock. And now again it has resumed that high top, high bottom structure. So I think this move could, this stock could make good returns in going ahead in the short to medium term. Support is around 195, so that's the stop loss coming in. At least for short term trading, you can keep stop loss below 195 and buy over here also. And on the higher side, if the trend continues, then 235 is the initial level that you can expect, where you can take a you can look to book some profits in the trading loans.
Okay, that's the view on Samvardhana Motherson. But last query then, this one's coming in from Aditya Reddy. He wants to know your thoughts on an SW Solar. Can we enter at the current juncture for the long term? That's the query. The stock was clearly in a downtrend in the last 1 month. Last week, over the last 5 sessions, it did try to make some bit of a recovery. Today again, just about managing to edge back into the green. Do you think the bounce that we have seen over the last week or so, do you think it's looking sustainable? And if yes, time to get in?
I think wait for some more time, because the stock had a good support around 600, 620 kind of range, which has been breached. And if I look at the monthly chart sectors, then major next support for the stock is coming around 450. So which is still quite far from current levels. So either let the stock show some signs of high top, high bottom structure getting formed. If not, and I think 450 would be, if the stock comes around 450, then the risk reward ratio would become favorable to take contra buys over there. So no clear signs at current levels. So I would know where I would advise to keep a wait and watch approach for fresh buying in SW Solar.
Okay, that's the view then. Keep wait it out. Don't get into it at the current juncture. That's the view coming in from Ruchit. With that, Ruchit, I would like to thank you for taking out time and joining in this morning, because this brings us to the end of the query segment. I look forward to interacting with you again sometime next week. Ruchit, have a great day.
Thank you very much.
Well, then, on that note, of course, taking a look at the markets, we are in fine fettle, but the mid cap index has given up most of its opening gains and, in fact, has slipped into the red as we speak. To understand the texture of the market here on and to understand what one can be expecting from the rest of the IT pack after TCS reported numbers last week, we are joined by Sandeep Agarwal, who's the fund manager at Sovilo Investment Managers. Sandeep, great to have you on the show. Before we talk about markets and other sectors, I want to talk about IT because TCS has really set a very subdued tone, right, for IT numbers. Margins have been disappointing, although the issue looks to be company specific. Higher third party expenses impacted margins. So, looking at TCS in particular, your thoughts on when can margin recovery really kick in? And secondly, in terms of Infosys, do you expect some bit of a revision in guidance, given the fact that there could be some bit of improvement in discretionary spending after that jumbo rate cut that was announced by the US Federal Reserve recently?
Yeah, hi, good morning, and thanks for having me on the show. First of all, on the TCS part, I think because of the BSNL deal, the margins were under some pressure. Otherwise, at the level of 12.3%, I think margins should have been slightly better. But I think we will see that recovery from next quarter because a part of the wage hike is behind, and now when you add the new workforce which comes at a lower salary level, the margin should improve. And revenue growth also, if you see globally, outsourcing has started doing well and consulting is coming under some pressure because people are cautious till the US elections get over and they see some they are able to measure the impact of US economy, whether it is a hard landing, soft landing, or what it is. But having said so, I would like to reiterate, which I have been saying for quite some time, that in most of the IT stocks have run up quite a bit and they have discounted all the positives. So, in my view, we will see more of time correction in the traditional IT services piece. In the ER&D side of it, there will be some more upsides which will happen because in ER&D, people are taking a decade or 2 decade call that because in ER&D the outsourcing is very low and most of the high growth is coming in that space. So people may take a longer term call and buy stocks at expensive valuation because they are taking a longer call. But in the traditional IT services piece, I think major run up has already happened in last 5 6 months in anticipation numbers we are seeing now. These numbers are not looking exciting because the stocks have run up quite a bit. So I would put it that way.
Would you have the same view on mid cap IT names? Do you expect numbers to be better compared to the large cap companies like TCS and Infosys and HCL Tech?
Yes, so in mid cap that trend will continue in my view because um there is actually globally there is a shortage of execution people, and hence whoever is able to execute or whoever has the bench to support execution, they are getting the business. So we are no more in a situation where demand is subdued. I think that reading is not correct. Demand is very robust excluding the consultancy side. So demand is good, and because of that, the mid caps will grow faster than the large cap. Having said so, mid cap are also trading at a much expensive valuation than the large cap. So there also I see limited upside. In my view, barring ER&D based companies in the mid cap, where there is a different story to buy. I think the IT services in the mid cap and the large cap IT services names all should have some challenge in terms of stock return in near term, while numbers will positively surprise.
All right. One stock, that's in focus and is among the top Nifty gainers is Wipro. Of course, the company will be, mulling a bonus issue on the 17th of October. Of course, Wipro, has been a laggard, right? There are a whole host of issues, and we saw that play out in the first quarter as well. Particularly talking about Wipro, if a bonus issue does come through, would that brighten the outlook for the stock?
It's very hard to comment on specific companies, but let me put it this way: bonus issue or something doesn't change the fundamentals of the company. Primarily, long-term investors will always look at the growth and the earnings and profitability to take a call. And I think while these are issues which are done with different perspective and also have some liquidity reasons for the company to do, but I think fundamentally it doesn't change any number. So we will be more keen to see changes fundamentally to at least come up to the market leader growth rates, which we have been trying to, we are awaiting for quite some time now, and it has been several quarters, I would say several years. So I don't think this makes any difference to the outlook.
Right. Of course, we have the second quarter earnings season that has just started. IT, of course, we've spoken about it in details. But where do you expect the outperformance to come from this time around? Banks, do you think margins will remain under pressure because there is an intense, fight for deposits, right? And secondly, cement is gearing up for a weakish Q2. We've seen the stock prices also remaining under pressure. So, where do you really expect the outperformance to come from this quarter?
So, let me put it this way: when I think we are returning to the period of 2018, 19, 20, where growth, people were chasing growth stocks, and then post COVID, people started chasing value stocks and turnaround stories. I think the euphoria to chase that turnaround stories and value stock will mellow down a little bit, but at the same time, market is always different. So, I assume that this time it will not be a straightforward chasing of growth stocks, but people will try to buy growth stocks at reasonable valuation. So I think a lot of brainstorming and research will come back now into the market, and based on that, people will try to find out sector and stock where there is good growth and these multiples are very reasonable. But thematic wise, I think water is a very good theme for next 3 to 5 years. Uh, Manufacturing remains very good theme. We see machine learning, AI, a very big theme, and I think power is the right way to play that theme because you don't have any direct play like Nvidia in India. So if you have to play AI, I think you should try to find some bets in the power side. All this will do phenomenally well, in my view. We are not very optimistic on banking because while the valuations are reasonable and the NPA cycle is not going to pick up anytime soon. But at the same time, I believe that the gap between deposit and growth, or deposit deciding the growth, will continue for a longer term rather than short term, because as awareness for other asset classes increases, which is happening, I think people will allocate less and less to fixed deposits, except in some pockets, and it is a raw material for the business. So if raw material is not coming cheap, you can't make money. So I think this in banking, we are not very positive on that side. Rather, we will play proxy and non-lending financials, which we believe are better options where growth is good and they're still available at reasonable prices.
Within the defense and manufacturing space, would you stick to a large cap names like L&T and other defense names? If we talk about the likes of HAL and Cochin Shipyard, most of these stocks have had a dream run, but they have also come off quite significantly from their highs, right? So within the defense and manufacturing space, which way would you look right now?
So we are, very heavily invested in our portfolio in manufacturing since last 2 years, and we continue to believe that manufacturing will do phenomenally well. Uh, One, government has a huge focus on that. Second, uh, the way we are seeing now private capex data coming in, there is some loosening of purse by industrialists to start capex. We travel a lot in the industrial zones of the country, and what we gather from there is that most of the private companies, small players in the manufacturing space, are ramping up capex, and so that space looks very very exciting. A lot of capex already is underway. A lot of capex will finish by next 1 year. So you will have a huge capacity which will be there, and when capacity is there, it brings economies of scale and earnings growth. So we are very optimistic on the manufacturing, whole manufacturing space, barring a small pockets where we believe that while manufacturing can happen, but the demand is little muted.
Okay, point taken. Last question, really. Where do you think the markets are headed from here? We've been fairly volatile. There have been quite a few reasons why experts believe that excess liquidity could be sucked out of the markets, given the fact that we have a big ticket IPOs lined up. Hyundai Motor India later this week, which is tomorrow. You have Swiggy lined up, NTPC Green. A whole host of IPOs are, expected to hit the markets pretty soon. Would that be a drain on liquidity? And in that sense, how do you really navigate the market?
No, you are absolutely right. On one side, India looks the only promising and green space where people should come and invest because we neither have any upcoming big election, we neither have any big challenges on the inflation or economy side. We have a good amount of working population. So all those things makes India a very very sweet spot globally, and for that reason we are expensive market amongst all the global markets, and this is without much allocation from the foreign institutions. So I think over a period of time, as foreign institution allocation starts coming in, we will see further this market getting further expensive because one difference which India has versus most of the other market is that here the liquidity in every stock is less because still most of the companies are owned primarily by the promoters. So that is one side, but at the other side, as you rightly mentioned, there are big IPOs coming up which will suck some liquidity out of the system. But I think the domestic liquidity still is very high, and the awareness in the retail investors, in other investors, is very high, and because of that, so much of money is coming every month in form of SIP. So I think we have ample liquidity, and there will be ample liquidity which will keep on coming. So wherever there will be opportunity, I think people will invest. So we will not see in my view, unless some global negative event happens, some major thing which we are not able to predict today happens. I think every correction will be bought in. That is the way we look at the market.
Okay, point taken. Sandeep, with that, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. Look forward to interacting with you again. Have a great day, and of course, have a great week ahead.
Thank you so much.
Thank you. Well, on that note, of course, we've come to the end of this edition of Opening Bell. Nifty, has gained traction. In fact, a triple-digit up move coming in on the index. We are above that 25,100 mark. Sensex as well, a good 450 point up. And the mid-cap index, although is underperforming, but has managed to edge back into the green after briefly slipping into the red. Of course, what's doing well, are names like BPCL, Wipro, L&T, HDFC Bank and JSW Steel. But on the other hand, you have some of the pharma names like Cipla not doing well, some banking names like Axis Bank under pressure. And of course, the big Q for today will be Reliance Industries that reports its numbers post markets today. And HCL Tech, on the other hand, will also be reporting numbers from the IT space. But with that, completely timed out. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and have a great day.